Hello everyone, in today's video we will be explaining to you how to read a balance sheet of the company or business. Today we have taken car manufacturing business as an example. Understanding this concept is crucial for analyzing the company's financial health. Let's get started. First, let's talk about the asset. Asset are the things that a company owns and expects to generate future benefits. Simply put, an asset is anything that can help the company make money or add value over time. We have two type of assets, current asset and non-current assets. Let's look at first at the current assets. In these are the assets that the company expect to use up, sell or convert into cash within a 1 year. These are the most liquid asset, meaning they can be easily converted to a cash or used in a short period of time. In current asset, we have cash in bank or cash in hand. This includes money in the bank or cash in hand or short-term investments that are easily converted into the cash. Then we have accounts receivables. This is the money that the company is owed by its customer. When a customer buys goods on credit, the amount they owe is recorded as an account receivable. In our example, if a customer buys a car on a credit or a loan, then he owes the company. So that comes under the account receivables. Then we have the inventory. This This include goods that are ready for sale or raw materials that will be used in manufacturing products. Then comes the prepaid expenses. These are the expenses that have already been paid but will be used in the future like insurance or rent. Then comes the other current assets, which includes the miscellaneous assets and other converted cash or short-term deposits. When we sum up all these, the, then we get our total current assets, as you can see in the Excel. Next, let's move on to the non-current assets. Some example includes property, plant and equipment. These are the physical assets that the company used in its operation like a land, buildings, machinery and equipment. Then there is a vehicles. These are the company owned cars. This also comes under the non-current assets. Then there are intangible assets like a patents or licenses. When we sum up these all, we get our total non-current asset. And when we add total current asset and plus total non-current asset, then we get our total asset. As you can see, here we have the formula of a total asset. When we add total current asset with the non-current asset, we get our total assets. Now let's talk about liability. A liability is something the company owes. It could be money owed to suppliers, loans from the bank, or unpaid bills. Liabilities are also divided into two categories, current liabilities and non-current liabilities. Now let's talk about the current liabilities. Current liabilities are debts or obligations that company must settle within the year. Here are some examples of a current liabilities. First is short-term loan. Money borrowed by the company that must be repaid within a year comes under the short-term loans. Then we have a supplier payables. This is the moneyed or amount owed to a suppliers by a company for the raw material or anything. Then comes the accrued expenses. These are the expenses that the company has incurred but hasn't yet paid, like unpaid salaries or bills, unpaid bills. The company sets aside money to cover the future warranty claims, like repairs or replacement for defective products. That comes under the warranty provisions. When we sum up all these accounts, we get our total current liabilities. Next, let's look at the non-current liabilities, which are a debts that the company will pay off in more than a year. Non-current asset includes example like long-term loans. These are the loans that the company has taken out, which it will repay over a several years. Then we have equipment loans. These are the loans taken to buy a manufacturing equipment, or it can also have a vehicle loan or any other loan. And when we sum up all these two accounts, then we get our total non-current liabilities. And when we add total current liabilities plus total non-current liabilities, we get our total liabilities, as you can see here. This is how you can find a total liabilities. Finally, let's discuss about the equity. Equity is the difference between what the company owns and what it owes. Means it's a difference between the assets and liabilities. It represents the ownership value in the company. It includes common stock, additional paid-in capital, profit from previous years, retained earnings, or etc. What is common stock? Money raised by selling the shares of a company comes under the common stock. Extra money invested by shareholders for the stock comes under the addition comes under in additional paid-in capital. Then profit from previous years can also comes under the equity. Profits the company has made and reinvested into some other businesses comes under the retained earnings. When we sum up or add these all accounts, we get our total equity. And then we have a total liabilities and equity. When we add total liability with the total equity, we get our total liabilities and equity. To summarize, here's a quick recap. Assets are what the company owns and can use to make a money. They are divided into current assets and non-current assets. Liabilities are what the company owes to others. They are divided into current liabilities and non-current liabilities. Equity represents the value of ownership in the company. Understanding these concepts help you know a company's financial health and long-term sustainability.